What's up, everybody? Mortgage rates are on the rise. What does that mean in this real estate market for buyers and for sellers? We're going to talk about it on this episode of Chasing Numbers with me, Noah Chase. So as you may know, the Fed just increased the Fed funds rate by 1/4 point for the first time in 3 years. That directly affects mortgage rates, and mortgage rates are on the rise. You'll see this chart for the last 3 years showing this drastic increase in mortgage rates over the last 3 months. What does this mean in this real estate market? Well, most buyers need a mortgage to purchase. And as interest rates go up, as the mortgage rate goes up, purchasing power goes down. I had Tyler Priest of Town Mortgage of the Carolinas give me some numbers that I'm going to show you right now. Let's say that you were pre-approved at 3%, which wasn't long ago, maybe a year ago, you were approved for up to $400,000 at a 3% interest rate. That gives you a payment around $1,815 a month. We're assuming that you had a 20% down, you had good credit. What happens when the interest rate's now 4%? Well, let me show you. This same buyer with a 4% interest rate can now only purchase up to $360,000. What happens if it goes to 5%, which we're really close to right now? So as you can see, as the interest rate goes up, every single point the interest rate goes up, your buying power goes down by about 10%. This is about 10% right here, this is about 10% right here, this is about 10% right here. So as these interest rates are going up, everyone's buying power is sliding down. 2 years ago, or a year and a half ago, you could get a $400,000 house. Now, if it gets to 6%, which I don't know if it will, but if it does, you can now only afford to buy a $300,000 house, and the payment is practically the same. Okay, so let's look at it a different way. Let's look at it at a payment per month basis with assuming we're going to do 20% down like last time, and we're also assuming that there's 1% for property taxes. Okay, so at a $300,000 purchase price at 3%, your monthly payment was about $1,327. Okay, I'm going to go through and I'm going to show you the increases at each percentage.
A few minutes later.
So as you can see, a $300,000 house with 20% down at 3%, the monthly payment is going to be $1,327. It increases to $1,461, $1,604, or $1,754 at a 6% interest rate. I did the same thing at $400,000 here. The 3% mortgage rate or monthly payment is $1,748, $1,926, $2,116, and at 6% is $2,317. As you can see, this monthly payment jumps significantly as the mortgage rate increases even by 1%. So we just talked a lot of numbers, but what do they actually mean? What it means is buyers have less buying power than they did even 3 months ago. And now buyers that were looking at $400,000 houses are now maybe looking at $350,000 houses, and $350,000 buyers are now looking at $300,000 houses, and so on and so on. And you need to, I want to reiterate that you need to make sure you are pre-approved for the current interest rate, because as you can see previously, as the interest rate goes up, your buying power goes down pretty significantly, up to 10% per one interest rate point. So what does this mean for sellers? We're not quite sure yet. The inventory is so low in the market still that even at specific price points, there are so many buyers, even if those buyers have slid down the purchase power scale, there's still so many that they're getting multiple offers on lots of properties. But everyone has a little less to spend. So at some point, these crazy offers that are going, $100,000 over ask, if they're paying 5% or 6% interest, they're not going to be spending that much more because they just can't afford it. In the short term, we're not quite sure, but the top as far as these wild prices on houses may be coming to an end just because the interest rate is going up and up and up, and these buyers are having to pay so much more than they did even 6 or 8 months ago. If you have any questions, let me know. I'm happy to talk, and otherwise, have a great day.